Great, glad you agree future tax rates will be higher and joined us for the second part of our informative video. Well, we're going to focus on two main aspects: making sure you don't pay more than your fair share of taxes, and to help battle inflation by making your money do more for you. So the key thing here is for you to be able to wrestle control of your taxes out of Uncle Sam's hands and put you in control of how much in taxes you're going to pay. Now, this video is specifically made for those who are in retirement and have between about 1.5 and 2 million, or those that will anticipate they're going to have between 1.5 and 2 million in qualified money. So that includes 401k, 403b, 457 plan, IRA, SEP, Keoghs. If you don't know what those two are, you're probably not self-employed, even pension money. So if that isn't you, if you're not in that 1.5 to 2 million, then click the back arrow, choose the right option, and go back and choose the right option, because the numbers vary quite a bit. So a key stat to remember from our earlier video, the one you just watched, was 81% of Americans make less than 75 grand. 90% make less than 100,000. And it's difficult to boost income taxes on those people because they really don't have a lot of money, and they also represent a majority of the voting public. Here's one we didn't share, and that's the median 401k balances for ages 50 to 59 is 62,700, for ages 60 to 69, 63,000, for age 70 and older is 52,400. If you probably double that with IRAs, you're not going to be able to generate much tax income from those folks either. Right? So what this means is Uncle Sam needs more and more tax revenue, he's going to continually lower the bar to whom he defines as being wealthy. So you're here, you've done or will do quite well through retirement savings and qualified plans. So you, my friend, have a huge bullseye on your wealth. So it's great that you're here, but you also need to take action to make the moves needed to make sure that you don't get stuck paying more than your fair share of taxes. Okay, so let's go ahead and move on. So remember, we're going to begin this assumption that we're married age 65 and older with $1.5 to $2 million in qualified money. So what we're doing here is we're looking to pull the most income out that we can in the most tax efficient way. So here's some assumptions we're going to make. We're going to make that Social Security is $30,000. So we chose that because the average person's getting $15,000 a year. You might be a little higher. If you'd like to see what it looks like with your numbers, we're going to give you an option to do that at the end of the video. So the 2021 standard deduction is $27,800. Now, where does that come from? So the 2020 standard deduction for married filing jointly is $25,100. So if you're under age 65, happen to be watching this, it changes the numbers a little bit, not hugely, but okay, because what happens is 65 and older, or you're blind, you get an extra $1,350 standard deduction per person. So there's another $2,700 here. What we're going to do is we're going to blow through some tax brackets here. We're trying to take the most tax efficient way of getting forever tax money that's sitting in your 401ks, your IRAs, your qualified money, and turn it into never taxed money. So we're going to blow through the $19,900 wide 10% tax bracket, the $61,150 12% tax bracket, and the $91,700 22% tax bracket. So that's a total income of $230,550. Although interestingly enough, we're only taxed on $226,050 of that. I'll get into that here in just a minute. Okay, so the standard deduction is important. Most folks that are retired don't do standard deductions. They don't itemize. They do standard deductions. If you happen to itemize, that just raises this number some. And it's a key number because it's essentially the amount of money we can take out without paying any federal income tax. So these are all hypothetical, and we're dealing with just federal taxes because state taxes are different from state to state. If you live in Florida, you may not have a state income tax. If you live in California or New York, you may have a really high one. So we're just talking about federal taxes here. But if federal taxes are likely to go up, aren't state taxes likely to go up also? Okay. So we want to maximize this number because it gives us this standard deduction, or itemized because it gives us the highest number of income tax-free. Okay. So we're going to pay $1,990 on the 10% tax bracket. We're going to pay $7,338 on the 12% tax bracket. We're going to pay $20,174 on the 22% tax bracket. Now we've got Social Security income, and we've pushed that to the 24% tax bracket because we don't have to pay taxes on every dollar of that. In fact, the most we have to pay taxes on is 85% of that. That's why we only have $226,050 taxable, because we've got $4,500 taken off the $230,550. So we're going to pay taxes at 24% on 85% of our Social Security, or $25,500. So that's $6,120. So our total tax bill, federal tax bill, There's only $35,622 on $230,550. It's pretty low, isn't it? I mean, did you realize that? Most people don't really realize that. So that means in 10 years we could take out $2.305 million and pay a little over $356,000 in taxes. In 20 years, we're going to be able to do $4.611 million and only pay about $712,440 in taxes. So people focus, when they look at taxes, they look at their marginal tax bracket. And they think, oh my goodness, I'm paying 24% taxes. Well, you are on $25,500. You're not paying 24% on $230,550. So we focus on what we call, it's the effective tax rate. And our effective tax rate on this is 15.45%. So if you could pull out $230,550 a year, because we're assuming you're not living on that much, okay, and only pay 15.45% taxes, wouldn't you do that all day long? I know I would. I think most people would when they really understand that. So I want to make sure you understand this part. You have enough money in your 401k IRAs, your qualified money, that you're likely to leave some behind. So any amount of qualified money that's passed to non-spousal heirs, so your kids basically, is fully taxed at their highest marginal tax bracket, and it can move them into a higher marginal tax bracket. So also the rules were changed that they only have 10 years to remove it all. A couple years ago, we still had the stretch IRA, where they would base how much they had to take out based on their life expectancy. So if they were 35 when you passed away, they might have 30, 35, 40 years of life expectancy left and be able to take it out over that longer period of time. Now they only have 10 years. So if we assume you died with $1 million balance over 10 years, that's $100,000 a year withdrawn. So assume you have 2 children, there's $50,000 a year for each. Let's assume they're both married, making $106,150 incomes. I did that because it pushes us to the top of the 12% tax bracket. They pay 22% federal taxes, plus whatever state is, on $50,000 or $11,000. Okay, but we feel that future tax rates are going to be higher, right? So could leaving $1 million behind your kids be considered money from someone wealthy? Well, when most 401ks, a median of them are, $50,000 to $60,000 or $50,000 to $70,000. Yeah, you could easily be considered someone wealthy, right? Whether you think you are or not, that's what they could easily be considered that. If it was 40% tax rate, thinking they're going to be higher, that'd be $20,000 a year. If they're 50% tax rate, it'd be $25,000 a year. What if they're 94? Oh, well, Kurt, you're crazy on that. Well, here, I pull this out for a reason. We need to understand history, or we're doomed to repeat it. So the highest marginal tax bracket in history in 1941 was 94%. Now it was on incomes over $5 million. You're like, oh, Kurt, that's a lot of money. It's a lot of money today. It's a heck of a lot more money in 1941. And you'd be right. But that was their definition of who was wealthy in 1941, was making more than $5 million in income. Okay, we had something, I guess it was kind of significant, happened in late 1941, December 7th. My favorite line from the movie Animal House was it over when the Germans bombed Pearl Harbor? It wasn't the Germans, it was the Japanese, but that drew us into World War II. So Uncle Sam knew we needed tax revenue desperately because we were going to fight in a war. And interestingly, the last time that our debt to our income, our debt to GDP was as high as it was World War II, was about 3 years ago. Okay, and we're higher than that now. So if we needed tax revenue during World War II because of our debt to income, and our debt to income is higher than World War II, it makes sense that we would need more taxes, right? So here's what happened in 1942. They redefined who was wealthy. They dropped that income level from $5 million in the 94% tax bracket to $200,000. It's a 96% drop. Okay, that's huge. They redefined you being wealthy from $5 million in income to $200,000. Now look, I get $200,000 still was a lot of money in 1941. Still quite a bit of money today, right? But what I'm saying is they have done this throughout history. That's just the most extreme example because they really needed tax revenue. Well, we really need tax revenue now. So could that happen again? I don't know. Yeah, it could, right? I don't know if it's going to. I don't think they'll do the 94% because here's what happened. So remember former President Ronald Reagan back in the 40s, well, long time before he was president, he was an actor. He got paid $100,000 a movie. It took him 3 months to make a movie. So in 1942, he was a smart guy. He said, all right, I'll do a movie from January to March and one from April to June, and then I'm done. Because every dollar he would have made over that, because he would have made $200,000, 94% would have gone to federal. He lived in California. The state tax was higher than 6%. So, I mean, technically, for every dollar he made over $200,000, he might have had to come out of pocket, not get any of that dollar, come out of pocket, pay some additional state tax on to California. But essentially what happened was any dollar he made over $200,000, he wouldn't see a penny of it. So why keep working? And that causes a problem because you get, you know, people, wealthy people changing their strategies, maybe moving out of the country. I mean, they have the wherewithal to find ways to reduce their tax bills. And one way Reagan did it was just to do 2 movies instead of 4. Now, was that a significant hurt on us? I don't know. If you like him as an actor, maybe it was. So, but I just wanted to point that out, that we do have significant historical events, or significant drops from the definition of being wealthy historically, is what I'm trying to say. So, wish I could have said that. Okay, so if we assume this couple has $1.5 million in qualified money and they're living on $100,000, that means in federal taxes they'd be paying about $77.26. Okay. So remember, we were working with $230,550, right, of withdrawing that. So would it be beneficial to withdraw an additional $130,550 every year, pay $27,896 in taxes on it? So over 10 years, that means paying about $279,000 in taxes for a $1.305 million, and over 20 years paying almost $558,000 for $2.611 million. Would that make sense? Okay. So if you could eliminate the tax liability on $230,550 a year for less than 15.5%, because that's our effective tax rate, 15.45, would you do it? If you would, then we definitely need to talk, and you need to look at ways to create ways to pay off the taxes on forever tax money and create never tax money. Right? And that's what we're going to do next, is show you a strategy that does that. So basically, if we're going to take that out and pay the taxes on it, we've got roughly $100,000 left, right? So let's assume we're going to take that $100,000 after tax and implement it into a strategy. And that strategy is going to be twofold, okay? So we're going to deal with a couple, and I'm going to choose a male and a female. And the reason I'm choosing a male and a female is because the numbers are just a little bit different between a male and a female, okay? So we're going to assume we're taking $50,000 for Mr., $50,000 for Mrs. We're going to put it into, remember, we want to protect it, so it's going to be safe from market losses. It's going to be able to, it's linked to the market, so it's going to be able to grab some gains when the market is up to a cap, lock in those gains every year and protect them. The money grows tax-free. It's accessible tax and penalty-free along the way. There's a couple of rules you got to follow. There's rules with everything. Not going to get into all the details on that right now. We can do that in a more in-depth call. All right, so we're following what our goal was, right? We're protecting it. We're tax-free growth. Okay, now we need to, can we multiply it? Well, interestingly, in this strategy, that $50,000 for Mr. actually buys $590,000 in death benefit. Okay, and for the Mrs., it buys $640,000. This is why I did it differently. Okay, I mean, I did a male and a female because it's a little bit different. And I'll get into all the details on this, and the little numbers are below. I'll get into it in just a second here. So over 10 years, that means you pulled out $500,000. You got $500,000 in cash value in the Mr.'s account, $500,000 in cash value in the Mrs.'s account. Now, here's what I did. I assumed no growth. Okay, I'm not saying that the account won't grow. I'm just saying that without growth, it still looks really good. Okay, but if you're protected from market losses, you're able to grab gains in the market up to a cap, lock those in annually. You're looking at historically, 5, 6, 7% returns over 10, 20-year periods in tax-free growth. So if the market does what the market's always done, and history doesn't predict the future, right? But if the market does what the market's always done, you're going to see some really good tax-free growth in this. If the market goes down for 10 years, you're going to be sitting around about here, okay? But if the market went down 10 years in a row, what would happen to the money you had in the market? Wouldn't you be basically almost totally decimated? Yeah, I think so. Okay, so we've got, so what this $500,000 in cash value does, it combines with the $590 in death benefit. So now we've got $1.09 million in leveraged death benefit, because the way the tax man looks at that $500,000 in cash value is it's part of the life insurance policy. Okay, so it's treated differently. And with the Mrs., she would have $1.14 million in leveraged death benefit. So the leveraged death benefit means that we've got our cash value that's helping leverage it higher. I hope that makes sense. Over 20, and that's $1 million in cash value that we have out. Over 20 years, each one has $1 million in cash value, so we've pulled out $2 million in cash value. Okay. Now we're going to make the next assumption is the Mr. dies at the end of 20 years. okay, and that they didn't use any of their cash value. He didn't use any of his, she didn't use any of hers. So what would happen upon his death? Well, she would get the $1 million in cash value. That's part of the death benefit, right? I'm just kind of breaking it down like an accountant would see it. And the other $590,000 comes from the actual death benefit in the life insurance policy. Okay, so now she's sitting on $2.59 million in cash. Okay, so she's got plenty of money going forward if she needs it, right? Okay, so now that's a great scenario, right? So we've multiplied the money, right? So let's assume now that shortly after he dies, her health declines and she needs long-term care. So if they had never met me, they would not have this situation. So if they'd never met me, they might be sitting with $1 million in their 401k account. If long-term care costs $80,000 a year, she needed it for 2 years. That's $160,000. So she'd have $840,000 in her IRA 401k left over after she passed away that the kids would have to pay taxes on. Okay, but since they met me, the scenario is this: when she passes away after that, there's a little over $3 million in tax-free money going to their heirs. Now, in the state, there could be estate taxes. The estate tax exemption is $11.5 million per person. So when he died, she would have gotten his 11.5 also. So she would have had $23 million. The current administration is looking to change that to $3.5 million, so it'd be $7 million total. So it'd still be, assuming that's how they do it, there still wouldn't be any estate tax. So there's absolutely no taxes on this money. All right. So did we multiply the dollars? Yeah, we added $590,000 and $640,000 in death benefit. Yeah. So I know death benefit isn't exciting because you have to die for it to be to take advantage of it, and you're gone. This is an interesting thing. Times have changed with life insurance. Not all life insurance, but this type of policy does this. So let's assume that they used all their cash value. They increased their lifestyle, which is perfectly fine when you've got death benefit to leave behind to the kids, especially when this happens. So basically, that $590,000 that he has, he could use all but about $20,000 to $25,000 of it to help pay for his long-term care if he needed it. Okay? She could use all but about $20,000 to $25,000. They leave that $20,000 to $25,000 because they have to leave it. The life insurance policy has to remain a life insurance policy, or it creates some tax issues. Significant tax issues, I should say. So she's got $615,000 to $620,000 to help pay for long-term care if they didn't have any cash value. All right. So what do we multiplied the dollars, right? We've protected them. They've grown tax-free. They're giving us additional benefits. They also let us spend more money if we want to, or not worry about running out of money and having to pay for long-term care if we need it because we've got the ability to pull it out of that death benefit. Any money that you don't spend out of the cash value or the death benefit passes to your heirs income tax free, and more than likely estate tax free also. Always consult your tax advisor. This is not considered to be tax advice. So, but here's the thing: if 40% of people in the pandemic have died because they were in nursing homes, you would never put someone that you love in a nursing home. And if you needed that type of care, if you needed specialized care, whether it's in-home assisted living, memory care, or nursing care, you'd like to have that. I'm assuming you'd like to have that at home. At home, I would too. I want to be able to control that. This gives them the ability to control that, pay the $80,000 a year that it would cost if it was high. I mean, if it was more, they'd still have enough money to pay for it and control where they get their care. And I think that's huge. If you don't, then we disagree on that. That's fine. If you don't care where you go, it just broke my heart to see people not being able to see their mom and dad or grandma and grandpa sitting in a nursing home and who, maybe got COVID and died, and they weren't even able to, hold their hand when they were dying. And that's just heartbreaking. So this gives us more control over those types of situations that are typically out of our control. The more money you have, the more control you have on it. Right, so have we not met the goals? We've protected it. We're growing it tax-free. You get we've multiplied the dollars. You've got access. I mean, do you know anything else in the world that can do this? You know what this is? It's cash value life insurance. Oh, I know. Oh, Kurt, I've never heard anything good about cash value life insurance. Really? This is pretty good. So now you've heard something good about it, right? Something really good about it. And I get there, I'm not saying that all that cash value life insurance is perfect. Nothing's perfect. There are some issues with it. One of the issues that's a valid concern. A lot of the stuff that they say is myths. Okay, they're making it up, and we can get into details on that if you'd like. But one of the things that's true is what we've done here is we have put the maximum amount of money in to buy the minimum amount of life insurance. That makes it the most efficient we can because it keeps your costs as low as possible. That is dictated by the tax law changes in 84, 86, and 87, TAMRA, TEFRA, and DEFRA. That specifies how much money you can put in, how much life insurance that needs to buy. So what happens sometimes with unethical agents is they bump the death benefit because we get paid on the death benefit. So if the death benefit's higher, we make more money. Now, if they tell you that up front, it's not unethical, right? If they do it without telling you, it is unethical. But you could sit here and say, well, you know what, Kurt, 590 is not enough for me and the Mrs. 640s, so we want $1 million each. Okay. Will it work? Yeah, it'll work. It won't be quite as good on the cash flow growth, but it'll still be really good. Okay. And yes, I would make more money, but you would know that because I told you that, and that's what you wanted. I wasn't trying to sell you more life insurance. If we could do this without life insurance, we would, but life insurance is the only thing that can do all of this. So think about this. Does your 401k give you tax-free growth? No. Right? Does it protect your money from downside? No, it doesn't. Does it give you an additional $590,000 or an additional $640,000 in death benefit? No. Does it give you extra money to pay for long-term care? No, it doesn't. It doesn't do any of those things. And those are all things that I think we would all want. Because here's the nice thing, because people can go out and buy long-term care insurance. I'm not a huge fan of it, because if you don't use it, you've spent all that money on premiums. Well, here, if you don't use it, the kids still get the whole death benefit. So it's not a use it or lose it proposition. Right? So once again, your heirs, I'm assuming that's your kids, would get any money that you didn't spend in the cash value and any money that you didn't spend out of the death benefit for long-term care. Right? Pretty attractive deal. Right, so here's the thing. If you want to, remember I told you got to take action. There's 4 things you can do. You can do nothing. You can try to do this on your own. You can go back to your current advisor and ask them to do it, although they haven't showed you this, right? Or you wouldn't be here. Okay. I don't know why you'd want to go back to that. And full disclosure, the 4th option is our favorite one. And that's where you have us help you. Okay. So you've got those options, but you need to take action on this if you're worried about higher income taxes in the future. Okay? So what we're offering is a no hassle, no cost, 30-minute strategy call. Okay. And we do that on a secure video conference. We've got a calendar below where you can book your 30 minutes where you can be in front of your computer. And once you do that, we will send you an email with the link to the secure video conference. We want that secure because you will divulge some pertinent, important financial information. We wouldn't want any prying eyes or prying ears to hear that. So go ahead and take advantage of that strategy call. Just to see what it would look like for you. I'll answer all your questions, and if we need to reschedule after a 30-minute call, if that's not enough, I'm happy to do that also, because I want to make sure that you fully understand what we're talking about here, because this is such a great option. I don't want anybody to miss out on knowing about it. You can miss out on not doing it, but it would be after you knew about it, right? The cash value life insurance is really it's a Swiss Army knife of retirement planning that Wall Street doesn't want you to know about, because if you did, you'd put more money with it and less money with them, so they wouldn't make money like they do, right? And that doesn't fit Wall Street's deal. And Uncle Sam in this whole deal, I don't trust the government any farther than I can throw it. And if you trust the government, then maybe I'm a big conspiracy theorist, but I can sit down and show you the numbers on a lot of this financial stuff that we talk about, that we've been led down the wrong path. But thanks for tuning in. Hopefully you found some great information, and I really hope to get the opportunity to meet you, even if it is just virtually to begin with. Thanks for stopping by.